In this video I want to tell you about one of the biggest fraud cases. Barings Bank, founded in 1762, was one of the oldest and most prestigious banks in the United Kingdom. However, in 1995, Barings Bank collapsed due to fraudulent activities conducted by one of its employees, Nick Leeson. This case study explores the events leading to the downfall of Barings Bank and the subsequent implications for the banking industry. Nick Leeson was appointed as a derivatives trader for Barings Bank in Singapore. He was responsible for arbitraging the price difference between the Japanese stock market, Nikkei, and the Singapore International Monetary Exchange, SIMEX, futures contract on the Nikkei. Leeson began engaging in unauthorized speculative trading, taking highly risky positions and concealing the losses. In February 1995, Nick Leeson, a rogue trader for Barings Bank, UK, single-handedly caused the financial collapse of a bank that had been in existence for hundreds of years. In fact, Barings had financed the Louisiana Purchase between the US and France in 1803. Leeson was dealing in risky financial derivatives in the Singapore office of Barings. He was the lone trader there and was betting heavily on options for both the Singapore, SIPEX, and Nikkei exchange indexes. These are similar to the Dow Jones Industrial Average, DJIA, and the S&P 500 indexes here in the US. In the early 90s, Barings decided to get into the expanding futures options business in Asia. They established a Tokyo office to begin trading on the Tokyo Exchange. Later, they would look to open a Singapore office for trading on the SIMEX. Leeson requested to set up the accounting and settlement functions there and direct trading floor operations, different from trading. The London office granted his request and he went to Singapore in April 1992. Initially, he could only execute trades on behalf of clients and the Tokyo office for arbitrage, lesson 10, purposes. After a good deal of success in this area, he was allowed to pursue an official trading license on the SIMEX. He was then given some discretion in his executions, meaning he could place orders on his own, speculative, or proprietary, trading. Even after given the right to trade, Leeson still supervised accounting and settlements. There was no direct oversight of his book, and he even set up a dummy account in which to funnel losing trades. So, as far as the London office of Barings was concerned, he was always making money because they never saw the losses and rarely questioned his request for funds to cover his margin calls, lesson 3. He took on huge positions as the market seemed to go his way. He also wrote options, taking on huge risk, lesson 10. He was, in fact, perpetuating a hoax in his record-keeping to hide losses. He would set the prices put into the accounting system and cross-trade between the legitimate, internal, accounts and his fictitious, 88,888, account. He would also record trades that were never executed on the exchange. Events leading to the collapse. Leeson exploited a loophole in Barings' risk management system. He was able to hide his losses by creating an account named 88,888, which he used to conduct unauthorized trades. Leeson's strategy involved betting on the direction of the Nikkei index. But as the market turned against him, his losses began to escalate. To cover up his mounting losses, Leeson created fictitious accounts and forged documents. He used these accounts to hide his trading losses, making it appear as though he was generating profits. The losses continued to grow, eventually reaching hundreds of millions of dollars. Discovery and collapse. In February 1995, Leeson's unauthorized trades began to unravel. A routine inspection by the Singapore Monetary Authority, SMA, raised suspicions about irregularities in Barings' accounts. Leeson was confronted and admitted to his fraudulent activities. Barings Bank quickly realized the severity of the situation and attempted to recover the losses, but it was too late. The losses amounted to £827 million, which exceeded the bank's available capital. Consequences and aftermath. The collapse of Barings Bank sent shockwaves through the financial industry. It exposed significant shortcomings in risk management practices and control systems within banks. The Bank of England intervened to prevent a systemic crisis, arranging for the sale of Barings Bank to Dutch Bank Ing for a nominal sum of £1. The case highlighted the importance of proper risk management, internal controls, and oversight within financial institutions. It led to increased regulatory scrutiny and the implementation of stricter risk management standards across the banking sector. Lessons learned. The Barings Bank collapse serves as a stark reminder of the potential risks associated with unauthorized trading and inadequate risk management practices. It underscores the need for robust internal controls, segregation of duties, and effective oversight mechanisms to prevent such incidents from occurring. Furthermore, the case emphasizes the importance of ethical conduct and the role of individual accountability within financial institutions. Leeson's actions were driven by personal gain and a disregard for the long-term sustainability of the bank. Overall, the Barings Bank case remains a significant event in financial history, prompting reforms and improvements in risk management practices to safeguard the stability of the banking industry. I hope you liked this video very much.